So last time we talked about how to learn from your customers in order to get them to tell you what they want and need. But your product or service will rarely exist in isolation. So you need to understand the market and the competitors. So in this short series, I'm going to talk about the market, your competitors, and positioning. So why study the market? You're aiming to size the potential and be precise about the opportunity that you have. So you need to do those because it's critical for the business case, which is working out your return on your investment. And it's also critical for R&D and manufacturing to understand the job that you're asking them to do, because building one of something is very different from making millions a year. So to do that, what you need is market sales data. Fortunately, that exists from many industry organizations for free, or also data companies have this information, although you probably need to pay to get it as precise as what you need. So I'm going to introduce you to a gentleman called Sun Tzu. 2,500 years ago, he wrote a famous book, document, called The Art of War in ancient China. And it's got many interesting statements and that are still useful today in warfare, but also for business, and particularly for relating to the competition. So the first of those are victory belongs to the side that scores the most in the calculations before battle. And prior information enables wise rulers and worthy generals to move and conquer, bringing them success. So that gives you an idea. 2,500 years ago, Sun Tzu already knew that it would be important to make the study before you do anything, and that's still true today in war and business. So the first step in sizing your market is understanding what we call a TIV. So that's the overall market size. So for example, if we were talking about passenger cars in Europe, the passenger car total market in Europe is over 10 million cars. But if you look at how that breaks down, for example, 70% of that is just 5 countries. If you want to gain another 10% to get to 80%, then that's 3 more countries. If you want to gain another 10% to get to 90%, that's 5 more countries. And if you want to get that last 10%, that's 17 more countries. Generally, every country you do has an additional cost related to it. So it's important to get a picture of the overall size of the overall market and then how that breaks down. And that overall market is what we call a TIV, which is total industry volume. So the next step is to look at a breakdown of that market. How does that break down? So there's many ways you can subdivide your markets normally, but you want to figure out where you want to focus. So for example, it might cost you significantly more to do all the possible combinations, or take a lot longer. So you need to know what to prioritize. So for example, again, if we look at passenger cars, you might realize that the global passenger car market for right-hand drive is less than 14%. So maybe you only want to make left-hand drive cars, and many companies have done that in the past. Then you want to look at the trend over time. So we talked about this before in terms of data. It's very important to understand how things change over time, but particularly for markets, you understand if it's a growth market or a shrinking market. So here, of course, we can look at the absolute numbers, which is the volume, but often that's quite difficult to understand because there's macroeconomic trends, societal trends, things happening that you can't understand. So what's interesting is to look at each subdivision of that as a proportion of the total. So that's market share as a percentage. And then if you look at that in this situation, you'd see, Germany is not only the biggest market, but it's also growing the fastest in the recent term. So that's a good sign. Then you need to consider the price impact. So particularly the price-volume relationship. So you will be selling a product or service, and it will be at a price point or a range of price points. And you need to figure out which of those you're going to target. So one useful tool for doing that is a bubble chart. A bubble chart shows you price and volume by competitor, by model, by some whatever you want to divide it by, but it shows you these kind of vertical trees, which are very, very useful to understand. Here's a price point, but maybe there's a lot of volume, but maybe the price point is too low for you to make money at. So that's important to understand how you're going to cover that. And with all of that information, then you need to consider accessibility, because that whole market isn't yours. All things being equal, customers tend to buy what they know and trust. So that means they tend to go back to things that are familiar. So if you go supermarket shopping, most of the time you go on the supermarket, your brain is kind of switched off and you're just picking up the things that you normally pick up. And it's exactly the same with most products. So for example, around 30% of new car buyers always buy from the same brand or the same dealer. So your chance of winning those customers is extremely low unless you have a super compelling offer. Similarly, car companies put a lot of effort into the way that the cars drive, the way they handle, accelerate, the way they sound, but actually only about 50% of new car buyers take a test drive. So they don't learn about all of those things until after they've bought the car. So your accessibility is quite important. You need to be careful to play to your strengths. So for example, one thing that's very common is that people tend to buy nationalistically. So of course, Germans buy more German cars, the French buy more French cars, and this sort of thing. So again, it's not that you can't win those customers if you don't have a brand from that country, but it's more difficult. You're fighting against something. And also you need to consider your offering. So are you selling all the possible combinations? We talked about how that maybe that's too expensive for you to develop. So what portion of the market are you able to cover? And then you need to consider about the purchase funnel. So how do customers arrive to decide to buy your product? So if you think at the top of the purchase funnel is 100% of the market is open, but then what's the awareness? How many people actually know about your product or your service or your brand? Even the best known brands still aren't usually 100%. Then what's the people's opinion of your brand or your product? And here it can be up to 50%. It's a huge amount, it can be reduced. Then if they don't have a good opinion about you, they're not going to proceed any further. If they do proceed, then maybe you make it onto a short list. Maybe you don't. Maybe there's other reasons why your product or service isn't attractive. And then once you've made it into the short list, you've got to beat out all the competition. And so when you get down to the bottom, there can be a tiny percent that actually is accessible to you. And like I said, you can have a fantastic offering and you can overcome a lot of these things, but you have to be aware, be reasonable about what's possible. So after you get to all of that, what you get to is your potential sales volume. So we've gone through these. You maybe you decide not to sell in the more difficult countries. Maybe you decide not to sell at a low price point. Maybe you decide not to develop all of the possible combinations, and then you lose some through the purchase funnel, and then you end up with 8 or 10% at the end. A couple of care points. It's very easy to deep dive into the analysis with a lot of data. You should try and avoid doing that. It can be a waste of time. You want to get just enough information that you can be confident in your decision. And the reason why that can be a waste of time is, as they say in the stock market, past performance is no guarantee of future results. So just because something is like it is today or like it has been in the past, doesn't mean it's going to be like that in the future. You just want confidence enough that you got the right direction. So why study the competitors? Well, we now know the scale of the opportunity, but how do you decide how much time and effort and money to invest in developing and making your product? For that, you need to develop goals and targets for engineering. And to set those targets, you need to know how the competitor products perform. Did they satisfy the customer needs? What are their strengths and weaknesses? And how do you compare? So again, we come back to Sun Tzu, and he said, know your enemy, know yourself, and victory is never in doubt. It's not quite that simple, but it's a good starting point. So first you need to figure out who your competitors are. An easy way to do that is brochure-figure analysis. So brochure-figure analysis is the easiest form of analysis because brochure figures by definition are publicly available. They're marketing data that your competitors have put out there, or maybe magazines have tested or something like that. And it's just free, and you can do as much analysis as you want. It's just your time. So you want to start at the beginning with all the possible players in the market, in the big market, not necessarily your selected niche. And all the data that the customer would use to compare the possible solutions. So here, for example, we could make some graphs of acceleration versus price, or driving range, or something like that. Then you want to narrow down that list of potential competitors. So in this situation, maybe I decide that I'm only focusing on a kind of specific price range, and actually I want to consider how the real customer would use the car. So I make up my own custom analysis, in this case 80% charge range. And that gives me a short list of competitors. And then you really want to figure precisely who are you going to be directly competing against. And that should give you ideally a list of somewhere between 3 and 6 competitors that you really want to focus on. If you've got a product in the market, you need to include that as a reference point. Maybe it's not exactly the same, but it's something that engineering can understand, and also sales and marketing as well. Also, it's very useful to include something above where you're going, maybe higher price or higher performance, and something below where you're aiming, lower price, lower performance. Because you don't want to be surprised by something above coming down or below coming up. So you need to understand fully a little bit outside your envelope. And if possible, you want to use forecast data of competitors' performance, because your product won't exist now, your product will exist in the future after you've built it. So it's no use knowing what happened in the past. For that, you need to know where they're going, how they're going to evolve. It's important to say, brochure data isn't enough. It's okay for selecting your key competitors, but you've got to remember that customers don't experience data. They have subjective, holistic experiences. Engineers need data. They need numerical specific targets. So you've got to find a way of translating the customer's subjective, holistic experience needs into numerical specific targets for engineers. And then when the engineers produce your product, you need to find a way of converting that performance into an experience for the customer to communicate to them. So next you need to do some benchmarking. For benchmarking, what you need is an expert in the product. Now that can be you, that could potentially be the CEO if you're in a very small company, but it should be someone who can evaluate the competitors from the point of view of all customers and users. Quite often you see with small startup companies, the CEO or the founders are making the decisions about the direction, and they're making valuations based on their own personality. And unless they're the only one buying the product, that's not a good way to go. So you need to have someone who can divorce themselves from personal opinion and not bring bias into analysis. You need to have someone who can explain their findings and the reasons why. And you need someone who can discuss those pros and cons both with sales and marketing in a way that's easy and understandable for someone who's non-technical, and with engineering, because engineering need to turn your findings into reality. So they need to then test all the competitors back to back, like a customer, in all the ways and scenes a customer uses the product. They need to give clear numerical ratings, because that's very understanding for engineering. And they need to be divided into subcategories that engineering can understand. And they need backup explanation why each rating was given. So I know quite a bit about this. I did this job for the car industry for more than 10 years. And I'll talk about that in another video. Then what you need to do is take those evaluations and you need to compare them to the customer priorities. So you should know the customer priorities from the surveys that we talked about in the previous video. And you need to take those priorities and put them in a structure that's something like Maslow's hierarchy of needs. Now, whether or not Maslow's hierarchy of needs is actually true doesn't really matter at this point, but the structure is very useful. So at the bottom, you have what's called deficiency needs. If you don't meet these needs, the customer will have anxiety, or they will have a functional problem, a real world problem. And at the top are what Maslow called growth needs, and these provide positive, enriching experiences. And in our product world, that relates to emotions. So if you rank those customer priorities on that kind of scale, then you can put them in categories that should be recognizable by the customer, but designed to work on what engineering is going to be doing, and arrange them in that order and split between those positive emotional needs and those functional deficiency needs. And then combine that with the expert's benchmark, and you should end up with some sort of graph like this. So From a position of strength, if you have monopoly or you're clearly the market leader with a strong brand and a loyal customer base, probably you don't take many risks. In most of those sorts of companies just update and evolve their product gradually, and they keep their loyal customers, and as we saw from the purchase funnel, that continues to help them grow and maintain and be very stable. And typically what they do is they wait for others to move and be innovators, and then once that innovation is proven as being acceptable to the customer, not damaging to the brand, then they'll follow. So for them, brand and loyalty are key. But even for those companies, I'm not really making this video for those companies, but even in those companies, there's a risk of becoming complacent and becoming a dinosaur. So there's many examples like that, like Blockbuster and Nokia and Kodak and things. So even those companies need to consider their positioning. So one thing to consider with positioning is what we would call the color of the water. So in an ideal world, you would have a blue ocean. So you would just be the only product in the whole market, no competitors. It's like a monopoly, but it's a monopoly that you've created by having a whole new market. That's ideal. You just have to match your brand and just sell to what the customer needs. That's perfect. The reality is that every blue ocean market will eventually turn into a red ocean, and more competitors will come and join. And each new competitor that joins with a similar product, they might bring some new customers, adding volume to the TIV, to the total industry volume with them, but they will also definitely take some market share. And that reduces the amount of the pie that you have. So we kind of want to avoid red ocean as much as possible. If you can't avoid it, then you need new ideas to find a competitive advantage, but it's quite tricky. Ideally, what you want to do is you want to carve off a different market, a niche, and that gives you a blue ocean situation for a while, but they will always turn back into red ocean. So again, we come back to Sun Tzu. He said, attack where the enemy is unprepared, appear where you are unexpected. So this is very good advice. Go back to your benchmark. So first of all, what categories align with your brand? You should always be thinking of the brand, because the brand is more important than the individual product. And the brand is what the customers understand, the brand is what the customers are loyal to, and you should be supporting the brand through every single product. So that can be quite easy for you to understand how you want to position. That doesn't necessarily give you uniqueness, because your brand might not be unique anymore. But let's look at each side of that picture separately. So first of all, let's look at the positive wants and needs, which is the emotion side. Here you want to look for the biggest gap to the highest position. So if the higher you are on this rating and the bigger gap you have to everyone else, that defines your character. Where you have those big strength points, that's your character. And if you don't have big gaps, then you're just average and bland. So on this example, you can see car C has several high points with a clear gap. That's a strong character. But it has one category which is below what we would call the minimum requirement for the segment, for the market, and it needs to be careful, because it can alienate or anger a lot of customers and drive them away. And if you look at car A and car B in here, they have the most average position, so they don't really have a strong character. They have to be selling on something else. Then if we look at the other side of the picture, the deficiency needs, so the functionality, here you just want to be above that rejection line, which gives you a minimum viable product. That prevents customers from rejecting you or complaining after the purchase. But on the functionality side, adding a lot more doesn't necessarily give you a much stronger product position, because it just has to meet the minimum requirements. And we'll talk more about this in the value video. But here, car C, which has a very strong character, actually has some elements which are below the rejection line. So that's a risk. They might have a very strong character, but they might be similarly driving customers away. Cars A and D are high scoring here, but maybe they're too high. Maybe they've put too much money into those areas. And if you look at car A in particular, you can see on price, they're clearly focused on price. Again, we'll talk more about that in the value and pricing video. So overall, how to position, you need to, first of all, size your market, identify your area of focus, identify your competitors, avoid the red ocean markets by standing out and looking for a niche, get an expert to benchmark the competition, align the benchmark results with the customer priorities, ensure the deficiency needs are above the rejection line, and target a few positive needs and wants where you can have a clear advantage versus the competitors, which align with your brand and give your product a distinct character. So, in the next video, we'll be talking about value and pricing. Thanks.